If you're thinking about buying your first home, there's a decision that comes up early, and almost nobody explains it clearly. Should I go conventional or FHA? These are just two different categories of home loans. Both get you the keys. Both come with trade offs. Let's break it down. No jargon, I promise. Credit score. FHA is the more forgiving option. Show up with a 580 credit score, and you're in, with 3.5% down. Quick definition, because I know this term gets thrown around a lot. Your credit score is basically a number that tells lenders how reliably you've paid back money in the past. Higher number, more trust. Sitting between 500 and 579, you can still qualify. You'll just need to put down 10% instead. Conventional has a slightly higher bar. 620 is typically your minimum, but get to 740 and you're in a different category entirely. That's where the best pricing lives. Down payment. Let me correct a myth while we're here. Conventional loans do not require 20% down. I don't know who started that rumor, but they owe me a public apology. First-time buyers can qualify with as little as 3% down. FHA sits at 3.5%, so these two are a lot closer than people assume. Down payment assistance. Good news. Down payment assistance works with both loan types. Quick definition. This is money, often from a state or local program, that helps cover your down payment, so you don't have to save the whole thing yourself. It depends on your state or local program. Some, like the HFA Advantage program, are actually built specifically for conventional buyers, covering both down payment and closing costs. Now, the monthly insurance charge. This is the part that usually gets explained poorly, so let me simplify it. If you put down less than 20% down, the lender considers you a bit more of a risk, so they require you to carry insurance that protects them, not you. Think of it like being asked to pay for your crazy driving ex's car insurance. That's essentially the arrangement. It's a charge that rides along with your payment until you own 20% of the home outright, what's called your equity. Once you hit that 20% mark, it's gone. On a conventional loan, it's called PMI, and it's the more agreeable version. Once you hit 20% equity, it drops off automatically. No paperwork, no phone calls. On an FHA loan, it's called MIP, and it's a bit more attached. Put down less than 10%, and it can remain for the life of the loan. The only way to remove it is to refinance later, meaning replace your current loan with a new one, usually to get better terms. Same concept, very different level of commitment. Closing costs. Quick definition here too. Closing costs are the fees you pay at the very end of the process to finalize the purchase. Think inspections, appraisals, paperwork fees. As a general benchmark, expect those to run around 4% of the purchase price for either loan type. In some cases, the lender or seller will cover a portion of that. It's always worth asking. That's not overstepping. That's due diligence. Processing time. When FHA is combined with down payment assistance, you're coordinating two separate approval processes at once, yours and the assistance programs. Think of it like waiting on a group text to land on dinner plans. It takes a minute. A clean conventional file through a wholesale lender, someone like me, who shops your loan across multiple banks for the best deal, can move considerably faster. The bottom line, FHA makes sense if your credit is still building or your cash reserves are limited. It's the more accessible entry point. Conventional makes sense if your credit is strong and you want to eliminate that extra insurance charge sooner. Either way, this is likely the largest purchase you'll ever make. Don't guess. Run both scenarios side by side before you commit to either one. That's exactly what I'm here for. Scan the QR code for a one-on-one consultation. No obligation, just numbers and information. Until next time, be smart, be fluid, and share this video with a friend who needs to hear this.